Did Snapchat or Snap stock SNAP just confirm that we are facing an imminent recession? The stock is down about 30% after hours. Why? Well, Evan Spiegel, the CEO, put out an internal memo that was slowly leaked saying, yeah, we're going to miss our revenue and earnings projections. So, yeah, we got to slow down hiring. And they subsequently put out a press release for the public investors saying, you know what? That guidance we issued just on April 21st, just a few weeks ago, yeah, that's not going to work. That macroeconomic environment has deteriorated further and faster than anticipated, i.e., this got real bad real fast. As a result, we believe it is likely we will report revenue and adjusted EBITDA below the low end of our second quarter 2022 guidance range. This is really interesting because this is saying just a few weeks ago, Snapchat has started seeing a significant decline in the economic environment. So what does this all mean? What does this mean for Snap? Why is Snap stock down so much? What does this mean about the U.S. economy? Why is this happening? What companies will this impact? And how should you consider investing in this environment? We're going to talk about all these issues and more. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. And so as we look at what's going on, you see that they previously were guiding to 20-25% growth and around break even to positive 50 million in adjusted EBITDA. But that followed 116% growth last year. So arguably very solid results, but then saying, yeah, May was so bad that we are not going to hit this. This is saying there's a pronounced slowdown going on right now. So not surprising to see Facebook stock down in sympathy, down about 7%, another core advertising platform, and also Google down around 3% after hours. Not as bad, partly because it's not as dependent on advertising as these other business models. Now, still heavily advertising dependent. Now, if you're interested in a more detailed video on Snap, I did a prior video, and in all honesty, I think I nailed it. You know, it was around 39 bucks a share. You can see the video, the stock price had just declined, you know, like another 20-30%. And I was like, you know what? Still too hard, still too much downside risk. You know, the upside of like 100% wasn't worth it. And so I called that out in a prior video for those interested. So the question is, what's happening now with the economy? What is it that we're seeing? Why is this all happening? And so, look, let's go back to that Walmart video that I just did a few days ago. And what they were seeing is, yeah, our consumers, they're facing some challenges here because higher prices with core goods like food and energy, that means they have less budget for everything else. So those everything else businesses like Walmart and Target, you know, that sell a lot of discretionary goods. They sell the core goods, but those are lower margins. They sell a lot of discretionary goods that are higher margins. Yeah, we're not selling as much as that. So our margins get the pinch. And then if you have a business model tied to helping sell discretionary goods like an advertising platform, yeah, they're facing the pinch too, because the consumer, once again, doesn't have the budget to deal with these pressures. And so look at what Snapchat helps advertise. You know, you want to get certain candles or some incense or scent. You know, here it is, do some e-commerce transactions for some discretionary goods. Yeah, that's going to take a hit. You want to, you know, get HBO Now, watch another season of Westworld. Yeah, well, if you're making a choice between food and Westworld, I think people are going to choose maybe I'd choose Westworld, but I think a lot of people have to choose food. And so that's sort of the challenge when you are an advertising platform like Snap, is that these companies, are they going to have the same advertising budgets when the end consumer doesn't have the money to spend it on these goods? So why is the stock dropping so much? So Snap is highly dilutive still. The share price or the share count increased by 5% in just the last quarter, and they're still significantly unprofitable. This creates this huge gap between what growth investors have been willing to pay and what value investors might be willing to pay. So let me elaborate on this point. You typically have growth investors up here saying, hey, what are the growth assumptions? Then what ends up happening is a company slips a little bit and they're not meeting those growth expectations. Ruh-roh. Then all of a sudden, who's going to pay when there's this sort of, you have growth investors up here, who's going to pay when expectations aren't what they previously were? They weren't at this hyper growth stage. Who's going to step in and buy? Because you have value investors all the way down here. They're doing dumpster diving. And they're saying, hey, I want real free cash flow. I want tangible assets. I want either an acquire, take private valuation. I want something that says, hey, I'm covered. And that's the reason why you can get these 30% drops with these business models that have yet to prove themselves, that are not free cash flow generative, that are significantly dilutive, that really haven't gone to scale. Yeah, because these growth investors, they're not stepping up if you miss growth expectations, and value investors, they're way down here. They're not looking to step up anyway anytime soon until there's like, hey, we think someone will acquire this company for around this price or maybe a 30% markup. So that's this huge gap that's created, and that's ultimately what you're seeing with stocks like Snap, and many others. So how am I personally playing this? First, a quick plug where if you're struggling with this current market environment and want expert investment insights at an affordable price, check out unrivaledinvesting.com. Subscribers receive write-ups on exceptional companies every month and can follow my real money investment portfolio. So a big thank you to all the Unrivaled Investing subscribers that keep this channel going. And if you are not an Unrivaled Investing subscriber, I do appreciate you hitting that thumbs up and hit that like button. So let's dive right back into understanding, well, what's going on here. First, a disclosure that you can read on your own time. So as I look at this, how I'm personally playing this, there's a couple of key points that I want you to consider. Once again, not financial advice. First is that we are in uncharted waters, folks. This is not what most people are accustomed to. Expect the unexpected. The reason why, look at the great financial crisis, look at dot-com bubble, look at LTCM, late 90s blow up. What happened? Every time there was a blow up with the stock market, who stepped in? Federal Reserve. Are we in a position right now where that will happen? Not necessarily. You could see the stock market drop 30% tomorrow, and the Federal Reserve would still say, tough nuggets. We got to raise rates because of price stability. We need to make sure we got to whip inflation now. That's what they need to do, because you're seeing these problems sort of percolate throughout the whole economy. Oh, the consumer can't afford food. Therefore, they can't afford discretionary items. Therefore, advertising for discretionary items takes a hit. Therefore, margins on these retailers take a hit. You see it after, all these secondary effects because you don't get price stability. Eventually, it leads to civil unrest, which I'd argue we have yet to see, but we'll see. And then that really does lead to the second key point you need to consider. When you face what could very possibly be a recession, which is arguably what Snapchat's saying, hey, these results were really bad. You know, what we saw in the last few weeks, way worse than what we expected. What happens if there's a recession? You have this sort of stagflationary situation where the economy's slowing down, people are pulling back on hiring, and yet inflation's still too high. What happens in that situation? Well, I'd argue you face much, much lower valuations. Because in a recession, you get this double whammy for stocks, where not only do the fundamentals slow down, like what you're seeing here with Snapchat, but you also get much lower valuations. You get this double hit where people say, no, I don't want to own this company because your growth is slowing. No, because you're burning at an even greater rate. And because you're growing at a slower rate, I'm going to go give you a lower multiple. It's just like what you saw after COVID with this massive stimulus, but the inverse, where all of a sudden companies were growing a little faster because of the stimulus, and then they got crazy multiple expansion. Now you're going to see fundamental contraction, fundamental slowing, and fundamental valuation contraction even further. That's, I'd argue, the challenge that we're facing right now. So how am I personally considering this? I'm saying every investment that I'm looking at, I either want a valuation backstop of some sort that's either in free cash flow, so maybe it trades at 10 times free cash flow, or low teens free cash flow multiple plus growth, or I want solid valuation backstop. Maybe it's trading below liquidation value. Maybe it's trading below book value. Something like that for my value-oriented bets. For everything else, like hyper growth, unprofitable companies, I want crazy upside. I want like 500% upside when I'm penciling something out, saying, you know what, you haven't proven your business model. We're facing a potential recession. The results from Walmart, Target suggest a tough consumer outlook. You see Snapchat saying, yeah, the economy got a lot worse in May. I'm seeing all these data points. I want to get paid. I want to get compensated. So I want really crazy valuation multiples. Arguably, I'm still not seeing it with a lot of these unprofitable companies. I'll call out a couple of things that I might be sniping at here and there, nibbling on. I call those out, obviously, to Unrivaled Investing subscribers. And so that's a key aspect, because this aspect of I want to get paid. So I'm either going to do value backstop, or it has to have immense upside potential for these unprofitable growth companies. And so, I think these are the key aspects to consider. I think looking at businesses like what's going on with Snap, where they're saying, you know what, we have to slow down hiring. They're not the first that's saying that. You see the same thing with Netflix, except they're laying people off. So you're seeing this one company after another dealing with this environment. So you see belt tightening by the consumer, you see belt tightening by the company. I think a lot of people can be impacted. And so if you find yourself that you could be one of the people impacted, I think it's important right now to say, hey, all these companies are getting their financials in order. I should too. So maybe even though inflation's still high, maybe that means holding a higher cash balance just in case you don't know what's going to happen with employment. So maybe that's unexpected expenditures or just having a higher cash balance to deal with these opportunities that might come up facing the potential double whammy of a recession where both valuation and fundamentals take a hit. If you found this video talking about the potential imminent recession as called out by Snapchat, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.